We know you want to take a victory
Sarah,
lap.
no,
the whole time you've been saying it pays to be bullish. Stocks are going to melt up. I think you even said it before Larry Fink said it. So you must feel a little vindicated.
Well, listen, thank you. I'm exceedingly humbled by that. But I will tell you this.
Yeah, right.
Wait, you're not going to say the shorts are bitter?
No, they are bitter.
That's what you said last time.
Yes, but here's what I said, and I was very blessed and fortunate to be on your network December 26th. And I said this: now is the time to act justly, love mercy, and walk humbly. 2018 was an exceedingly humble year. We were humbled by being bullish, and we are humbled now for being right again. There's three problems with the market right now.
You were wrong in 2018. You're right in 2019.
Right. We were wrong for the fourth quarter, Sarah. We missed our target by 15 points on September 30th. 15 points. So the fourth quarter we were wrong. 6 times in 30 years the market's been negative. I'll take those odds, okay? So going forward, I think the markets in the rest of my compatriots are wrong for 3 reasons. Number one, my compatriots on the strategist side remain way too macro-driven. This is not a macro market. This is a market of stocks. We have to increase our fundamental investing. Number two, we lack perspective in my field. Why? Majority of strategists are either quants or macros. They don't know how to talk to stocks. And oh, by the way, they've never even owned a stock. We have a very good fortune of running $2.7 billion of equities for our clients at BMO. And number three, it's the whole notion of we're so afraid to be wrong, we don't want to be right. Portfolio turnover is the highest I've seen in my 30-year career. We're speed dating stocks. We're not owning stocks. And we're trading in and out so fast we're missing the fundamental realities that American earnings are the strongest and most stable in the world, period. We're so afraid of missing everything else in the world, we're missing our best companies in the world right here in the United States.
So you think there's more room to run?
I think there's more room to run. Now, guess what? Over the next few days, we're going to hear sell it may go away. I can't wait for that. It's going to be great. We're going to slow down a little bit, but the second half of the year, I remain with our call. The second half of the year, earnings are going to be stronger than everybody anticipates, and no earnings recession.
I see you nodding your head, Joyce.
Well, we have had a 3,000 target for the S&P 500 since early December, so through the market sell-off. But we do watch the liquidity factors very closely right now. So we've been very comfortable with that target, and I do think it's about the revenue growth, which has been above expectations. It's been also about the margins, and it's also been about the record buybacks. We expect $850 billion this year. So we've stuck with our call since December that the stock market was going to come back strongly from what was a liquidity-driven sell-off.
Well, you say you focus on liquidity. Well, but the factors, what are you focusing on when you say that, and where are we?
Well, I think that you've had one of the most V-shaped moves that we've seen in the marketplace, arguably of the last 50 years. And so you had a very sharp downturn in December where the risk of recession was being way overpriced by the market. So we thought you would have a very big recovery. Now, in the first quarter, you've had that earnings have surprised, and we are bullish on the energy sector. That's one where we you have had a call out there now for a number of months. This is one that could actually play catch-up. And I think with Iran sanctions, you actually probably have a little bit more upside coming up on oil.
So now we're in a period where people are looking at RSIs. They're arguing things are expensive. When do we start reading that Europe is the new long? Something like that.
Well, again, let's go back to fundamentals, Carl. Our view is that Europe's the next Japan. And it's going to
Meaning
no growth.
Decades of lost growth?
Decades of lost growth, stagflation.
I don't know. They have a higher per capita GDP than we do. Their stock market has been doing just fine.
Well, no, their stock market, during a holding period analysis, Sarah, you would have lost a lot of money. What happened in 2016 is a lot of global investors left the United States because they didn't like President Trump. They went to Europe. They lost a ton of money. Then they chased emerging markets after our great run in 2017. Foreign investors are underinvested in the United States. I would say this, on a technical perspective, technicals only confirm what's happening fundamentally. Technicals do not lead, fundamentals lead. And things are going to have to slow down a little bit, there's no doubt about it. Something that Joyce talked about is very important. We've seen a broadening out in the rally. Last year we were very concentrated. We see the majority of sectors do very well. And so we think that we've returned back to fundamental investing, active investing. You want to be more concentrated in your portfolios and really make your bets. But I do think that we are going to start to see better global growth that's really going to be driven by emerging markets, not Europe.
Where do you want to be in the market right now? In the U.S., Joyce? And if so, what sectors?
Well, we're overweight in the U.S. and we like the energy market, but we also think that the growth numbers out of China are going to be more stable. And we do think you're going to see some good news on U.S.-China on getting a trade deal, even if some of the technology and enforcement issues are outstanding. So we like emerging markets, we like the U.S., we like the energy sector. We're also pessimistic on Europe. Now, not only have the growth numbers been weak, the PMI is very weak, you also have European parliamentary elections coming up. You have this lingering uncertainty from Brexit, so we're more cautious there. We think that's going to hurt earnings.
You also write that China's AI capabilities will potentially exceed that of the U.S. over 5 to 10 years? Is that a maybe or a probably?
Oh, I think it is going to happen. I think that China's ability to go to mass production on AI sets it apart. They have much more centralized funding. So it's not about innovation. I think the U.S. and other countries lead on innovation, but their ability to go to mass production, it's cashless. It's not even credit cards. It's QR codes now. So China's ability, whether it was manufacturing or AI, just to actually get it out into society at a broad scale has been unparalleled.
Implications for us here in terms of just, I don't know, migrating tech into public life, whether it's autonomy or anything else?
No, I think that's very important. I mean, we show a slide that you've seen the 5 biggest consumer staple stocks over the last 20 years become a decreasing amount of the market. Look at the 5 FANGs, now the 10% of the market. And I think those are the new consumer staples. And I think tech is going to continue to be a major play, and that's why we are long. But we're long from a fundamental perspective because of all the 11 sectors of the market. Tech by far is the most stable earner.
Within tech, chips continue to hit new highs, Brian. You still want to be in a group like that? It's been one of the biggest winners of the year.
It's a great question, Sarah. We would say that we own stocks like Intel and Texas Instruments for the dividend growth. We avoid the Momo, Go-Go stocks, and we like Microsoft and Apple and those types of names.